Down payments. The bigger, the better.
Not.
Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's quick take, we are going to discuss down payments. The who, what, when, where, and whys. Let's just start right off the bat and say that mathematically, I understand the concept that if you pay a greater down payment on anything, doesn't matter if it's a car, doesn't matter if it's a home, whatever it happens to be, if you pay a greater amount of a down payment, that means you're going to have less to pay off. And could you possibly shorten up the time frame wherein to do that? So mathematically, what are the results there? Yes, that leaves less for you to have to pay off, but I think we need to look deeper than that. So especially for everybody out here who's vetting, and especially for those that are implementing the infinite banking concept already, let's consider a couple of scenarios. Let's say it is a home, okay? So let's say it's a home and you're going to try and avoid the PMI. You're going to pay 20% down payment. And then let's just say you were going to do a 30-year. I know you 15, 30, okay, but let's just take 30 for an example. Because you've paid 20, you have that much less that is spread over the 30 years. Yes. A couple of things that I would point out. When you look at that scenario, one, we are going to circle back to the death benefit. Can you tell that I talk about whole life policies a bunch? But we're going to talk about that down payment. Also, yes, the remainder of what you owe is going to be spread out over 30 years, and that's less of a number. But remember this, the volume of interest has not changed on this amount of time. So for 30 years, especially for the first several years, and let me interject here also, most people move every 5 to 7 years. It's good to know because this process is getting ready to start all over again. But in those first several years, you are paying volumes and you're bleeding out volumes and volumes of interest. Those are dollars that you will never get back. Okay, but you're trying to avoid the PMI, save some money there. I get it. Okay, that's a scenario. It's a common scenario. Let's look at another scenario where you still go the 30-year route and you pay less of a down payment. So that does mean that you're going to have the PMI and that's going to be a cost. Take that into consideration. And yes, I am just talking concepts here. Maybe we'll get to some numbers, but maybe not. Because when you understand the concepts, the details don't matter so much. In this scenario, we're going to get to ask the question about that down payment that you otherwise would have been shooting, let's say, for the 20%. But let's say you pay 5%, 10%, 3%. I mean, whatever the minimum is in your given situation. And you do have the cost of the PMI, and you are still amortizing over the next 30 years. Here's my question that I don't think is being asked like it should be. Can you think of something that you would do with that $5,000, $10,000, $20,000, whatever the number is? Is there something that you could think of doing with not the full 20% because you just pay the minimum, whatever elsewise would have gotten you up to 20% to avoid the PMI? Can you think of something that you could do with $5,000, $10,000, $20,000, or whatever the number is, that would make more money than what the PMI is costing you? That's an honest question. I don't know your answer. I'm asking you to consider. Do you know what to do with capital to be profitable? Is there some experience, some gift, some aptitude, some knowledge, some skill that you have where you could mix that with that capital and be more productive and profitable than if you had have just liquidated that principal into a down payment? So again, I'm not saying that math doesn't work, that the way that math works, if you pay a bigger down payment, does that mean you have less to pay off over the length of time of the amortization? Yes, but what if you could do something even better? Maybe you can, maybe you can't. Maybe the best thing for you is to pay the 20% and have money in your hands because you're not knowledgeable, don't want to be knowledgeable, you're not interested in doing better, you just want to play it safe and do what's conventional. Now again, let me preface here by saying that when you're vetting or implementing the infinite banking concept, you don't have to work harder. You don't have to change your cash flows. You don't have to take on any additional risk or lose control. You can just add one step to what you're already doing and become your own banker and be that much more profitable in what it is that you're already doing. So I'm just asking you to consider, what could you do with that capital instead that would make you more profitable and not the banks? Because I know folks that are out there, and I'm not telling you to do one way or the other, but I know folks that are out there with interest-only mortgages because they know what to do with capital. And they are very, very profitable with what they are doing with capital. And they want to send as little as possible at any given time to the conventional banks for things such as mortgages. So for those of us that are proactively and intentionally going about the business of buying and acquiring assets, wherein we use those assets to pay for our liabilities, here's a great place to talk about buying and funding and owning and operating properly structured whole life policies with mutual companies that pay dividends, funding those policies, paying premiums into those policies, leveraging the cash value of those policies via policy loans to have down payments, or we could be talking about anything, but then you still have the asset. You're still going about the business of being a consumer, like we're all consumers, okay? But because you know what to do with capital, and because you add that one step on the process of becoming your own banker, now not only can you have the house, but you can have the house and get the money back. See, anybody can go out there and conventionally do things like get a house, but this is where you can get the house and get the money back. So I hope that this has been helpful and an interesting conversation. If you've had a takeaway, let me know what that is down in the comments section below, or reach out to me. And if you'd like to have a conversation about how to implement the infinite banking concept into your household or your business or your investing, then let's have that conversation. This has been a great pleasure for me. I look forward to our next one. Have a great day. Take care. I just kneecapped myself getting down into my chair. Good grief. Ouch. Don't even get me started on the down payment and closing costs, approvals, principal, interest, etc. Who really controls the banking function in that? Down payment? Down payment for what? Get out of here. 20%. You're crazy.